Hello, friends. So today we have amongst us Mr. Tridi Bhattacharya, who is the Senior Portfolio Manager with Axis Brand Equity PMS. Welcome, Tridi.
Thank you and good morning.
So, we would like to understand from you, first of all, what is the genesis of philosophy of brand equity PMS?
Thanks for the question. The investment philosophy of Axis Brand Equity Portfolio revolves around creating brands as a tool for wealth creation for investors over time. Brands, in our opinion, create bargaining power in front of customers. This bargaining power manifests itself in the form of pricing power in front of customers, whether it's consumers, businesses, employees, or suppliers for that matter. We think that combined with underpenetrated and unorganized markets like that of India, when companies with pricing power operate in such an environment, it leads to superior growth, returns, and margins over time, which in turn generates wealth creation over time for investors. That's the underlying investment philosophy that we operate with at Axis at Brand Equity PMS.
Sure. So just to understand it further, so why have you selected? What is the reason? What is the genesis of giving so much impetus to brand? As maybe first filters to ultimately getting into building of a portfolio.
Brands, in my opinion, ultimately result in brand is basically a mental shortcut, which whether it's consumer or it's a business, they do while selecting their suppliers. And this is built substantially over a period of time through consistent execution. Once that gets through, we believe that leads to consistency of financial performance over a period of time, and that is a strong barriers to entry.
Sure.
And ultimately, the holy grail of investing is basically what we call as barriers to entry for that business. It leads to a sustainable moat, and that, in our opinion, finally leads to wealth creation for investors. And that's really the genesis why we think that such an investment philosophy, which revolves around investing in businesses with a moat, with a brand being the key part of it, results in ultimately the wealth creation.
Right. The first thought that comes to my mind, and I think would come to all investors, is that over brand builds over time.
Yeah.
Right. And as you say that as you mentioned that there are financials also get built.
Yeah.
And then hence there is a history, and eventually the companies are selected.
Yeah.
But the fact is that don't you think which means that the portfolio is focused more on large cap oriented companies? Because the first thought that comes to mind is that because these are brands, they would be large cap in nature.
Interesting question. Before I get to that question, let me give you a statistic. When you talked about brands, and in the line of the question that you asked, it takes about 30 years to create a brand. There is academic evidence to prove that. One. Secondly, only 15% of the companies which start out to do so actually make it to being a brand. Okay. So there is a very high mortality rate of companies failing to do so. In other words, when we pick stocks, when we pick companies for our portfolio, there is a huge margin of safety built in the business itself over a period of years, which are given by customers in their line of business. That's just as a starting point. Now, regarding your question whether it's a large cap or a small cap, I would probably kind of answer this through the lens of the life cycle of a brand. And I would go something like this, saying that about 40% of the portfolio is what we call as emerging brands. These emerging brands are brands in the early part of their life cycle, which are either present in one particular part of the country, which is India, or a particular segment. Like V-Guard, company from the south, focuses on switches and cable and looking to go national. Okay. About 40% of the portfolio comes from companies like these. In traditional language, you would call them mid caps or small caps. They obviously come with high alpha potential, but they have their dose of risk as well, which is why it's broadly at about 40%
Sure.
and not 100. These are well-known companies, and the companies like SDFC Bank, companies like Asian Paints, who have historically delivered sustainable and risk-adjusted financial performance over time. These set of companies are there in the portfolio to provide a steady bedrock of return for investors over time. And the final 10 to 15% would come from what we call as turnaround brands. These are brands which have had a strong history, have had a strong recall in the past, but have fallen by the wayside for some reason or the other. ICICI Bank, for example, amongst others. These companies are there in the portfolio to provide a market agnostic return, which is very company specific, and depending on what the company does, the stock price return will be proportionate to that. So in summary, what I'm saying here, that this is a multi-cap portfolio, not a large cap portfolio, which is a mix of 40% coming from mid cap and small cap, 45% from large caps, and the turnaround brands could be in either category, large or small. So rather than looking at on a market cap capitalization basis, we tend to look at brands in their life cycle and evaluate companies and also present companies in that merit.
Sure. So portfolio mix is multi-cap,
Yeah.
with emerging as well as established brands.
Correct.
Now, what is the stock evaluation process?
Yeah.
So, brands is a broad way to emerging and established is a broad way to kind of think about it. But
Yeah.
what are the mathematical filters?
Yeah.
So how does a stock get added, and how does a stock get exited from the portfolio?
Thanks, Kamal. I would say that we actually follow a 3-step process, 2 of which are quantitative in nature. And this quantitative filters, so to speak, gets us to the right starting point, after which we do qualitative analysis in the form of meeting the companies, meeting their competitors, suppliers, to arrive at our estimate of intrinsic value. And finally, if the stock is 20% or more below the intrinsic value, we go ahead and take an exposure in the stock. So what are those 2 quantitative filters? Number one is an effort-based filter. Here, what we look for is what the company is doing to create a brand for itself. Is it spending enough on advertising and promotion if it's a B2C company? Is it spending enough in R&D expenses if it's a company looking to create a brand by creating intellectual property? Is it a company paying royalty to the parent if it's an Indian subsidiary of a global brand, which ultimately uses the brand name in India? Okay. As a result of this, a lot of companies which are listed but don't have any investment in brands get eliminated here. This filter, in many ways, focuses our attention at the right starting point so that we don't get digressed by, maybe a company that exists by virtue of either regulation or, for that matter, some sort of government jurisdiction that they have been given to them. So that makes us focused in companies where there is some sort of brand creation happening, or at least the company is looking to create a brand for itself. The second quant filter is some efficacy of the spend, whether the spend that they are doing in creating a brand is working or not. In other words, is the brand gaining market share? Is the return on capital employed greater than cost of capital, which are the very basics of how the brand should really work. Once we get through this, we get to a code list of close to about 350 odd names. That's when we do a deep dive into the financials, look at the competitors, look at the suppliers, and finally, arrive at our intrinsic value to finally create a portfolio of broadly 20 to 22 names, minimum 15, max 25 for our investors. Hopefully that answers your question.
Sure. And like you in the earlier question had mentioned that there are very few brands which over a period of time actually become a known name, and the failure ratio of a brand is fairly high. So in that regards, give us certain statistics and also kind of share what are the risks, which investor should know before he invests in a portfolio like this.
Sure, indeed. I think risks are a key thing to evaluate before we get in. And I would answer this question in the form of, again, the life cycle of a brand. The life cycle of a brand goes through 4 stages broadly. An emerging stage, where companies are earlier in their life cycle, after which they go on to become an established brand. And then if things don't go right, if they get complacent, that's when they get into what we call as a fading brand. And if they continue to be in that category, either they become a dying brand or they become a turnaround brand. So if you recall, when I answered your spread, the question on the spread of the portfolio, I talked about emerging brand, established brand, and turnaround brand. The risk of the portfolio is if any of these companies which are there in any of these categories are getting into the fading brand category. And that's where a lot of our research is focused on. We look at market share data. We constantly speak to, what in Porter's framework they describe as speaker to the outer circle of the company, speaking to the suppliers and the competitors and whatnot, to get this early when it's still in its infancy, so that we can spot some of those early fading brands and get out of it. Because the fading brands are where maximum amount of capital loss happens. So, many companies in the life cycle have done so without getting controversial. If I look at global example, Nokia, and multitude of Xerox, multitude of such companies have kind of been complacent at the top and eventually got into fading brand and could never come back. So our research process not just looks at companies which we are looking to invest in, but also on a periodic basis looks at companies which could get into the fading category and cause capital loss and take action at appropriate time.
Sure. So, just adding on to your earlier part of discussion. So, currently your portfolio is a mix of, say, 60% towards established brands and 40% towards emerging brands. Is that correct?
No, broadly, I would say that 40% is emerging brands, about 45% is established brands, and about 15% is what we call as turnaround brands.
Right. And turnaround brands, can you give certain examples?
So, for instance, we have a meaningful position in ICICI Bank in our portfolio. We think that, if you go to the hinterland and over the decades or so, ICICI Bank has built a good bit of franchise amongst its customers, whether it's depositors or people whom they've lent to. But over the past 4 or 5 years, we all know, courtesy the corporate banking issues, they have got into a bit of a mess. And now with the new management, they are looking to sort of make a comeback. So this is an ideal scenario where company has a strong brand recall, fallen by the wayside over the last few years, and now looking to make a comeback. So ICICI Bank would be a perfect example,
Sure.
which will fit into that. Divi's Labs, when FDA inspectors sort of invested their facilities and put them under watch in which they couldn't produce, so their earnings and revenues collapsed around that period of time. But soon enough, they got their act back together, and now it's back up and running, which means they're back on the growth trajectory. So these are the turnaround candidates that we tend to look out for in the turnaround brands category.
Sure. So you have given example of emerging brand as V-Guard. You've also covered examples of turnaround brands. So give us a few examples on the established brands.
Yeah. So established brands, I would are the companies which are well known to investors. Okay. Here you have companies like SDFC Bank, like Asian Paints, and some of the traditional large cap other names like Kotak Mahindra Bank and whatnot, which have had a historical track record of sustained delivery. In terms of, I'm talking about financial delivery, and the management is well known. It is kind of treated at par with maybe the bellwethers in the individual industry. What that does is these bunch of companies may not grow as fast as that of your emerging brand, but that 20% or 15 or 20%, that growth rate is a lot more sustainable and a lot more consistent as opposed to what we see in emerging brands, which has a bit of volatility. So if you follow that back to stock returns, by and large, that leads to a steady stock return or steady bedrock of return for investors over time. In other words, cushions some big drawdowns that might happen in the portfolio in volatile times in the markets.
Sure. Can you also explain certain statistics in terms of your average market cap, your trailing P or forward P of the portfolio?
Broadly, if I look at the price to earnings multiple of 1 year forward, our portfolio would be at about 26 times 21 earnings. And if I look at the earnings growth of our portfolio average over the next couple of years, that will be around 26-27% again. So broadly, we are paying a fair price for the growth that they are getting for. Neither we are overpaying nor we are kind of significantly undervalued. What that goes on to show is one of the important characteristics I would like to highlight, which is that ultimately we are looking to play on the earnings power of the business.
Right.
So if the earnings power of the portfolio is growing at about 26%, whereas if you look at the broader market, it's growing at about 3, 4, 5, 6, pick a number, percent per annum, then over 3-5 years for investors to get a compounding, the 26% compounds at a far higher pace as compared to that of a broader index. That's one. Not only that, since we are not overpaying for the growth that we are anticipating, broadly speaking, the returns are a little bit here and there, but broadly speaking, in line with that of the earnings growth. So over the last 1 year, we would have done something like 23% return for our investors, which mirrors the kind of earnings growth that we have seen that we expected to see over a period of time. So on net balance, I'm saying that this is a portfolio which is which is focused on understanding the earnings power of the business, which is growth at a reasonable price, which focuses on the theme of brands. And we think that brands in India, in the context of India, are still in its nascent stage, much as we saw in the US in 1970s and 80s, where whether it's consumers or business, appetite for owning or using brands as as a supplier is only going to compound from here or increase from here over the next 10-15 years. So we see actually good times for our strategy going forward on a long-term basis.
Sure. So, what are your views? So your performance on the portfolio for last 1 year, as you highlighted, has been very good. What are your views on current market environment? What do you see is changing, and how you think is going to impact to your portfolio?
So I think, overall, we think that if you look at last couple of years, some of the seeds of change planted by Modi government have been around, whether it's demonetization or GST. All of these ultimately is leading us to what we call as formalization of the Indian economy. In other words, in India, while there was a cash economy and a legitimate economy, we are gradually moving towards a crunching cash economy and moving towards a legitimate economy. What that means from the companies that we analyze, look, and invest is that organized sector, better part of organized sector is brands, will tend to gain market share meaningfully over time. And we are seeing some initial signs of this, but we think that over a period of 3 to 5 years, this trend is going to accelerate. To take an example, if you look at the jewelry market, broadly the jewelry market has been flat. But if you look at Titan's growth over time, it has been north of 12-13% over time, which means they've gained significant amount of market share as compared to their competitors in a broader market which has been flat. Even in a quarter like what we have gone through, where we know that economic growth has been anemic, one of our portfolio companies reported revenue growth of close to about 20-odd%. Whereas if you look at BSE 100's financials growth, that's been actually flat to -5%. So in such environment, when times like these, when economic growth is kind of hard to come by, we find that brands gain market share. Sure. And hence, if we think that if this slowdown is going to continue for a few more months or maybe 3 to 6 months, we think that brands will get tremendous amount of market share during this period of time. That's the short term. Over the long term, we think that courtesy some of the measures taken by the government, we will actually move towards more formalization, which means brands should gain market share. So I think on net balance, we think that the current economic setup and also the steps taken by the government orients quite well for the strategy that we run. India has always been a bottom-up stock pickers market.